So for tonight, what I'd like to do is to try to attempt to answer the question I'm asked most often. What is the outlook for stock and bond prices over the coming year? I mean, that's pretty much top of mind for everyone. For better or worse, that means we must talk about the Federal Reserve and interest rates, whether we want to or not. I personally would rather not, but we have to, simply because they're the most significant influence on our asset prices. A very quick cursory explanation of interest rates, because it's kind of encompasses a very broad variety of prices and rates. The short-term rates are really controlled by the Federal Reserve, and certainly influenced by politics and some other players, but that's basically how that works. Whereas long-term rates, maybe think of mortgage rates, they're more determined really by the market, buyers and sellers, influenced by the Fed for sure, and also influenced by expectations about inflation. So just with that very quick glance at interest rate structure, how it works, where are we today? Like, how are the financial markets today? How is the economy? And how is the economic outlook likely to influence our stock and bond price? Well, as has been the case for quite a while, as investors, we continue to be confronted with expensive asset markets. Stock prices are at very elevated levels, interest rates still quite low on a historical basis. Now, in both cases, prices have come down a bit in recent months, but for neither could one plausibly make the case that either is at bargain levels at this point. Now, for the economy, I would say the news is better, because we had an economy that was basically already strengthening, decreasing virus cases, massive government spending. It's more than likely to result in some very gaudy figures for economic growth as the year unfolds. But as to what this might mean for the markets, unfortunately, there's just no easy or right answer. So even though we suspect the economic news will be quite good, that can't be guaranteed. And even if so, there's still numerous uncertainties. So to try and get my arms around it all, I've identified 4 financial scenarios. And then I went ahead and assigned very subjective probabilities to each, and also tried to envision how the stocks and bonds would fare under each scenario. I've even named the scenarios to help keep my own thoughts on track. So the 4 scenarios I've identified and named, I've called lockdown. Number 2, spending with no regrets. The 3rd, unsupervised. And the 4th, stern parenting. So I'll start off, just taking one by one. Lockdown is basically what it sounds like. For whatever reason, vaccines fail, variants run wild, some unknown wild card, the economy fails to take off, and in fact sinks back to the dismal days of spring of 2020. That, as sad as it might sound, is a great environment for bonds, a bad one for stocks. I don't consider this a likely event, so I gave it a probability of 10%. The second one I mentioned, the spend with no regret. This is more or less the environment being predicted by Treasury and the Fed when they, the last couple of days testifying. Individual and government spending will boost the economy significantly, but without any effect on interest rates or inflation expectation. So long-term interest rates remain low. The government's easily able to run huge deficits at little cost. This scenario, so-so for bonds, pretty good for stocks. And as much as everyone would love this scenario to occur, and as much as it was being promoted the past, few months really, I only assigned it a probability of 20%. I just don't think it's likely that with the explosion of economic activity that's foreseen, along with the policies of the new administration to encourage wage inflation, that wages and costs won't rise, and that these won't have impacts on inflation expectations. So spending with no regrets, I hope it comes true, but I've only given it a 20% chance. The 3rd scenario I mentioned, unsupervised. So economic activity soars as the mood brightens around the country and perhaps the world. Many of the lost jobs return, hospitality, travel, they surge back. Life begins to resemble 2019. inflation does begin to spike. Long-term interest rates do rise significantly in response, and the Fed does nothing. Unsupervised financial markets. It sticks by what it's really been saying now. This was all predicted. The effects are transitory, nothing to worry about. This scenario is a pretty bleak one for bonds, quite frankly, and a fairly good one for stocks, at least for 2021 or until the sentiment in the Fed changes. Out of the four scenarios, I believe this is the most likely, and I give it a probability of 40%. The fourth scenario that I mentioned was the stern parenting. So basically that's identical to the unsupervised scenario, except this time the Fed does step in and tries successfully to subdue the party. They raise interest rates, halt all the other extraordinary measures that have been taking to pump money into the economy. When all is said and done, this scenario ends up being decent for bonds and a pretty rough go for the stock market. I gave this scenario a probability of 30%. So then I obviously kind of stood back, take a look at the various probabilities and what was likely to happen. I reviewed them. I'm left to conclude that the outlook for bonds isn't great under any scenario except for the lockdown. So I think it's definitely very wise to continue to be defensive towards that asset class. Just a lot of risk there without a ton of reward. The outlook for stocks is more mixed. Really just the question again being when or if, but really when, the Fed starts to tighten the monetary policy. And under three of my four scenarios, that doesn't happen at all in 2021. So we can, if you believe everything I've said so far, that could be encouraging. I think it is a little bit. My final takeaway before I, just want to reach out and see what's on your minds is actually sort of a less optimistic one, maybe a more sober one. Because really, however, at some point, whether it's this year or next year, the speculative excesses that we see in the stock market, especially towards the end of last year and early this year, they will be reined in. Interest rates will rise. And one dramatic impact of those rates, besides anything with the markets, will be a huge jump in interest expense for the government. And at that point, we'll really and finally, almost initially, feel the impact of the deficit. The government's ability to spend on discretionary items will be constrained, even with the tax increases that seem more and more likely. So as sobering as it is, the cost of the pandemic will endure many years after it was brought under control biologically and medically. So thanks to everyone. And Steve, I guess if you want to, or I guess we can allow people that have questions, unmute yourself, please, and I'll do my best.
Hey, this is Holly. I just wonder, with all of those four scenarios, what you think you might do and how that might look for portfolios, knowing that you can't predict.
Thank you. I would say that I honestly think that things were maybe positioned in 2020, almost I think appropriately for this year. Because if you, whether in your own investments or really probably through everyone that's on the call, when they look at their bond investments, you would say, oh, wow, we don't really have any 30-year bonds here. We don't have any long-term bonds, or we have a tilt towards inflation-protected bonds, things like that. That seems to me to be the appropriate approach to take with the fixed income side of our portfolios, where we really don't want to undergo losses. And I'm not looking in the rearview mirror and trying to say that any scenario has happened so far in 2021, but the interest rates have gone up quite a bit, the long-term rates during these first few months of the year, and the index fund that holds very long-term treasuries has managed to lose about 15% in 3 months. So that's not what we want to have happen for the part of our portfolios that are supposed to be secure. So we want to try to avoid that kind of risk. And I think, that's really how we plan on positioning ourselves. And with the stocks, I didn't really talk about tech stocks versus value or anything like that, but the more kinds of things that we have in the portfolio that respond well when the economy does well, they do make sense. Maybe they didn't make sense last year. The kind of, whether it's in energy or real estate or banks or insurance companies, none of those were in favor last year. But as we get into more of an environment where things are doing well again, those type of assets will respond. They've already begun to respond. And some of the sectors that were more dependent on the lockdown kind of economy, the Netflixes and that sort of thing, nothing against them, they would be a little less in favor. And I do think we've been trying to do that from the portfolio side as well. And almost it's for that reason, and also just for the reason that even though the technology's had a bad couple of months, there's still so much optimism baked into the price of those stocks. They haven't come to a point where they're really attractive yet as we look out over 2021.
So Nate, it's Linda. I have a question. My understanding from what I've read is that if there is a tax increase, it would be for incomes over 400,000. Is that correct? Do you think that's actually what it's going to be?
Well, I think we're in a race right now to see who can get their tax ideas out into the public first and see if they can get a toehold, because there's so many of them going around. There's really nothing been formalized yet. And the other thing about that, just to remember, I know you know this so well, but they're going to have to find 50 senators to support something, so the moderate Democrats become the key constituency for that. And so I'm not, I think it's just so early to speculate, because you've got Senators Warren and Sanders already starting with a wealth tax. I don't think that'll get any traction, but you never know. There's ideas about eliminating the estate tax. That'd be a big money raiser. Again, is that going to get 50 senators? I don't know. So it's pretty uncertain. And I think if it works out where it's tried to tie into another huge spending bill, that just makes it that much more complicated to get through. If I had to guess what would end up happening, I would just kind of, I could see it could just be sort of a reversion to the tax rates that we had with Obama. So I think the marginal rates would go up by a couple percent. Things would be tweaked here and there. I don't think the deduction for state and local taxes will come back. I haven't seen that being bandied about. So that was the one that the Trump tax bill took away. I don't see that one coming back. So there doesn't really seem to be any appetite around to have any kind of tax cut for anyone, particularly people that benefited from that advantage who are the relatively well off. So, at this point, it's way too early to tell, but if I had to guess, I would just say it would sort of be some marginal increases in taxes and a pretty healthy increase in corporate tax, which might not matter to the stock market either, because it didn't really matter when Trump cut the taxes, and it probably won't matter too much if they go up a few percent.
Thank you.
Sure.
Nathan, it's Rick and Susan.
Hey, Rick.
We talk about infrastructure. Classically, I think of roads and bridges, but I gather it's much more broad than that. And I wonder if you could comment on which of the infrastructure needs is more likely to gather the largesse of the Fed, of the Congress.
Mm-hmm. Well, there's the road and bridges that, of course, congressmen always love because they get something built in their district. So that one, they usually get a lot of support for that. I think what we definitely found over this past year, that broadband is a pretty compelling infrastructure need that this country has done a pretty poor job on. So that would be probably actually a pretty low cost, high payoff kind of thing that people should be able to support. I think I'm not sure if we'll ever need one again, but no, the last airport that was built in the US, I believe, was in Denver. Which was, I'm trying to remember, maybe 40 years ago, something like that. So we've got some, well, we will have some crowded airports again, I think.
LaGuardia.
Oh, LaGuardia was the last one. I thought it was yeah, okay. So yes, it's been a while. So we've got some, we'll have some airports pretty much over capacity once people start flying again. And I guess it'll be a little, I don't want to say tricky, but just maybe problematic to generate a lot of support for, or maybe get through Congress. Because I think what's going to be wrapped up inside the title infrastructure is a bunch of clean energy initiatives, which in some, it depends on how it's done. They can be quite costly with not a great economic payoff, or it can be done in, more targeted ways that have more clear benefits. That one obviously is tricky because of the political conflict about whether, the whole thing about what we need to do for the environment. So that's, I think, part of why the total dollar on the infrastructure is so high is because it includes a lot of things like charging stations for the electric vehicles and things like that, I'm not sure about if it'll get passed. But hopefully the broadband will, for sure. And there'll probably even be some things with schools. We'll probably be able to call that infrastructure, as again, one of the holdups in opening up many schools, particularly the urban ones, is the poor physical state that they're in and the lack of ventilation, those kind of issues. So that could be, I could see that getting a pretty decent amount of support, because we've definitely found out that if the schools aren't open, the parents can't go to work, especially the moms, and that's had a pretty bad effect on the economy.
Thank you.
Thanks, Susan. Okay, so I think what we will do is, as always, Steve will process the recording, get it up on the website, send everybody a link. I think what I'm going to do is basically transcribe what I wrote, because obviously I have a sort of a semi-script here. If anyone does follow me on LinkedIn, I'll put it up there. Depending what people think, we might just send some of the thoughts out to everyone. I'm a little scared to put too many things into writing because in 3 months I could look really dumb. but so we'll definitely try to make these thoughts available, because I know just during a call sometimes the words can go by pretty quickly. But definitely want to thank everyone for joining and just for being with us throughout these difficult times. I know it's such a cliche, but definitely the ups and downs in the world and in the markets over these past years. So we really appreciate everyone and everyone's support. And I just wish everybody the best, and we'll talk with you all soon.
Thanks, Nate.
Sure. Thanks, Doug. Thanks, everybody.
Thanks, Nate.
Thanks, Nick.